Now record. All right, welcome today to Mastering the Consumer Credit Game. This is the last 2024 Get Savvy Grow Your Green Stuff webinar for this calendar year, but we're going to pick things back up in January with two webinars on taxes. My name is Andrea Pellegrini, and I run the University of Illinois Systems Student Money Management Center out of University Bursar, and I'm joined today by my colleague, Nikki. Nikki, do you want to introduce yourself?
Sure. So I'm Nikki Jankola Shanks, and I am the policy director for Lieutenant Governor of Illinois, Juliana Stratton.
Thank you, Nikki. Collectively, the Get Savvy webinar team represents organizations across the state of Illinois, as you might have guessed, which rest on the ancestral lands of multiple Native nations, including the Peoria, Kaskaskia, Piankashaw, Wea, Miami, Mascoutin, Ottawa, Sauk, Meskwaki, Kickapoo, Potawatomi, Ojibwe, and Chickasha nations, and we have a responsibility to acknowledge these nations and work with them towards a more vibrant and inclusive society. So we like polls. We actually are doing a lot of polls today. Hopefully I find them quickly. We're going to launch a poll just to see who is joining us today. So hopefully that window of demographics popped up. You can kind of let us know what age range you fall into, whether you're a student or full-time employee, etc., your gender, race, ethnicity, and that helps us kind of understand who is joining us today and how to modify some of what we talk about, the examples that we use to target who is with us. All right, so we have a large age distribution, which is great. Credit is super confusing, and it seems like there's new credit products every day. I think we updated the slides up until this morning, just on new information coming out. We have lots of students and full-time employees. We have both men and women, non-binary folks, and we have just a lot of diversity going on. We really appreciate you responding to those polls. I'll share that real briefly so you can see kind of who's joining us with you today, and I'll stop sharing. Hopefully that little box goes away and you can click out of it if it didn't go away, and it will pop back up when I do the next poll. Today, we're going to discuss how to practice positive credit habits. We're going to explore ways to build your credit history. We're also going to hopefully get you to understand how to improve your credit score or scores and discover how credit scores impact people's lives, not just related to the cost of borrowing. And we're going to identify some resources for building credit to your advantage. So we're going to try something new today, and we're going to put in the chat, Richard, if you can put in the chat the link to this Padlet. What we want you to do is exit out of here real quick. In Padlet, once you get to this, it's not showing up. Richard, are you dropping things in the chat? There we go. All right, so the Credit Thoughts Padlet, this is the first time we're using it. There's a little plus icon in the bottom right-hand corner. If you can click on that, you can write a word that comes to mind when you think of credit, maybe a phrase, an idiom, maybe a words of wisdom that you heard. You can also search for images or animated GIFs. So maybe you think about opportunity or maybe a new car. I'm going to put a car. Ta-da! And then you can publish it. We think about loans, stress, pressure, all right, interest fees, credit cards. Yeah, credit cards are a common tool to use with credit, borrowing, credit score gift, a catch-22, doubts. I feel like we got a lot of negative emotions going on, right? Scams. 200 to 800, so numbers,
Before the States, money managing after the United States problems. That was very interesting to me.
And there's probably a lot of complicated feelings and thoughts that you have around it. And that's kind of what we wanted to get at with this little Padlet activity. You can continue to add to this and we'll look at it later. But in the interest of time, I'm going to keep moving along with our slides. All right, so I believe it's Nikki's turn to talk about credit basics.
It is. All right. So let's go through some of the very basics so we make sure we're all on the same page using some of the same terminology and understanding. So what exactly is credit? So there's a few things that all goes into credit. First, you have the consumer. You borrow your money today and you're saying, I'm going to borrow this today. I'm going to pay it in the future, but that's going to cost me something, which is known as interest. And then that equals credit. So the main goal of credit is to have money today. And even though and then pay it back in the future with interest. So with some form of cost. When you see credit, think of some sort of almost like a loan. It is a loan. All right, so some credit system basics. As we said, the credit system is very confusing, but this kind of gives you the overview. So the service, any company that you use credit for, they report your payment history to the credit bureaus. So your servicer share, so like your cell phone bill reports all of your payments to the credit bureaus. There are three, which we'll talk about. Then the credit bureaus can feed a record of all of your payment history and any other information to your credit report, which then leads to your credit score, which are numbers created from the data in your credit history. And then that score is your credit worthiness, and that impacts your access to money and cost of many financial services within the system. So that's kind of the basic flow. We are going to talk about each of these different aspects, but that's the flow. There are different credit bureaus. There are three main ones. There's Equifax, Experian, and TransUnion. These are the three. They each keep a separate report. So you don't just have one, you have three. And you have the right to a free copy of your credit report every year, but also currently at www.annualcreditreport.com. They're still doing it. It used to be once a year. They're still doing it from the pandemic weekly.
So legally, you're entitled to it once a year, once every 12 months from each one of the bureaus. But luckily, the credit bureaus decided to provide free online access only every week to all consumers.
Yeah, so you could get it online. You could also request like a hard copy, but you can get it at that link online. This is credit bureaus, credit reporting companies, consumer reporting agencies, any of those types of names are always referring to these three credit bureaus. All right, so what's in a credit report? A credit report is different than a credit score. A credit report is a profile of your credit history. The lenders use your credit report to learn how you have and try to see how you handle your credit in the past, and then it helps them to determine the risk of lending money to you. So the businesses, so I'm gonna talk about these three, and there's more aspects, but these three to start. You have your personal identification information. So that's going to be your personal name, address, date of birth, social security number, your employment, collection agency, one thing I want to note too, your race, color, religion, national origin, sex, or marital status are not in your credit report. Then, sorry, the collection agency's account information. This is and public record information. The public record information is going to be anything like bankruptcies, foreclosures, lawsuits, liens, any wage garnishment type remarks by the court that says you have to pay anything. The middle one, the collection agency account information, that identifies any accounts that the servicers, the agencies have, or excuse me, identifies any accounts that companies have placed for collection with a collection agency. So if you're not paying your bills and it goes to a collection agency, that is going to also appear on your credit report. Creditors can actually report even very small unpaid amounts. It could be a library fine, for example, could show up on your credit report. Two things I want to really stress here is that any sort of collection agency, collection action on your credit report is a very negative information and will affect a lot going forward. It will affect your report, which will affect your credit score. The other thing that to be aware of is that bankruptcies stay on your credit report for 10 years. So if you're not repaying your debts, this is where it kind of all comes to be laid out, is in your credit report. Next slide, Andrea, thanks. All right, so what else is in your credit report? So you have those three on the left-hand side that we just talked about. It also has your credit accounts and usage. So if you have 5 credit cards, whether that's a certain store credit card, a bank credit card, whatever it might be, it's all on there. It's also going to show companies that requested your credit report. That could be, it could be for something like you're buying a home, and so your mortgage company is going to request your credit report, or whatever it might be, it will be listed there. And all of your student loans will also be listed separately on a credit report. So something to know is that we talked about the bankruptcy can stay on there for 10 years, stay up to 10 years, but also any negative info stays on your report for 7 years. So if you miss a payment on your credit card, which, let's be honest, happens to everybody, it's happened to me, it's just part of what happens, that missed payment will stay on your report for 7 years. If you now look at student loans, if you default on your student loans defaulted student loans can stay on your credit report indefinitely. So 20 years from now, if you defaulted on your student loan, it stays on there. I see a question, what is a defaulted loan? A defaulted loan means that you're not paying your student loan payments. It's usually about 10 months, right, Andrea? 9 months?
It's 270 days, so it's like between 9 and 10 months. And the Department of Ed usually gives like a little bit of leeway on when they start reporting delinquencies, but you're technically considered delinquent if you're 1 day past due.
So other types of bankruptcies and negative info eventually falls off your credit report, but defaulted student loans do not. So why is all of this important? How you manage your debt and your credit report actually impacts a lot of your day-to-day. So it could affect renting an apartment. People can pull your credit report and your credit, because your credit report is going to ultimately also factor into your credit score. So renting an apartment, getting a job, some jobs do pull this information. Um, obtaining and cost of a loan, if you go in to purchase a car, or a house, you may get a higher interest rate because you are a higher risk profile person to lend to. That this could also be even your cell phone bill, can be more. If you're trying to start your own business, you're going to have more startup. You may not get as many small business loans as you may be interested in. So it's not just a major purchase is what we want to get at. It's not just when you go buy a house. It could also affect little, quote unquote, little things all the way through. I apologize for my coughing.
I think you and I got a frog in our throat at the exact same time that the webinar started. So I feel like I've recovered a little bit, hopefully, and I can take over for you now. You're welcome. All right. So for those of you that don't know, Steve Bob is also in the chat and is knowledgeable on credit, specifically credit related to entrepreneurship. So he's answering a lot of questions, and we will also try to answer questions either in the chat when we're not speaking or at the end if we can't get to them. So we were doing our best. But let's talk about some healthy habits to help you build your credit if you're just starting out, or if you've had some hiccups and you're looking to build some healthier habits. So first, it's important that you keep in mind that each person who borrows money has responsibilities. If you're the borrower, it is your duty to know what you can afford to borrow, what your own needs, desires, values, and habits are related to spending, and to provide up-to-date and accurate information to your lender. You don't want to try to commit fraud trying to get a loan. In order to maintain the contract or pay back a loan or a creditor, according to the lending contract that you have agreed to, you need to understand the terms of the loan or the line of credit. If it's a credit product like credit cards, you want to pay your bill on time and understand what the cosigner responsibilities are if you have a cosigner, or if you are a cosigner. So in thinking about cosigners, let's talk a little bit about what that means. So sometimes people choose to be a cosigner on a loan to help someone else qualify for a loan, or maybe perhaps to get a loan with a lower interest rate. So cosigners have borrowing responsibilities too. So why do you think someone might need a cosigner? With a lot of students, you might need a cosigner if you're a younger student because you don't have credit history, right? It's hard for us to establish credit history before we get any, which is kind of a cyclical problem. It also, because of this, provides more security for the lender if you have a cosigner. Cosigners take the full responsibility for the repayment of a loan. So for example, if I cosign on a loan for my niece, if my niece doesn't make the payments, all of that delinquent information is going to go on my credit history, and because I am equally responsible for paying the debt. So if the borrower defaults, or like I said, stops making payment, the cosigner is responsible. So it's important that you're aware of that if you are co-signing for a loan or if you're asking someone to co-sign on a loan for you. Your ability to borrow in the future may also be affected by co-signing. So it's important to keep those things in mind. For example, like I said, defaults and missed payments will go on your credit history and will affect your credit worthiness, which can impact your access to financial services later. So in thinking about how to build positive credit habits, there's four main things that we're going to talk about today. We want you to check your credit reports, which we've already mentioned. You can go to annualcreditreport.com for all three of the bureaus. You want to use credit regularly. You want to make payments on time, and you want to pay down your debt. So this first habit that we want to talk about, check your credit reports, we're going to do a little quiz about. So we have Jessie, and I'm going to launch this little quiz about Jessie. So Jessie wants to buy a house. I just launched this. They check their credit reports to see if there are any errors. As a result of looking at their credit reports, do you think their credit score will go up, go down, or stay the same? All right. We have a lot of people responding. It looks like we've had 70% of participants have responded. Most people are saying stay the same or go down. All right, we got up to 73% participated. I'll leave it open a couple more seconds. Make sure to hit submit after you have selected your choice. All right, up to 80%. We're going over a lot of stuff, so I'm going to go ahead and end the poll, share the results. So the correct answer is stay the same because Jessie is checking their credit reports themselves. This isn't part of a credit inquiry into like applying for a loan. It will stay the same. It will not impact it. So like I said earlier, you can access your credit report from each of the three bureaus for free at annualcreditreport.com. We already talked about federal law giving you access to one free credit report from each of the bureaus every 12 months. You also have not just the legal right to check your credit reports, it's also responsibility to do so. Unfortunately, you do not have the same legal right to do that with credit scores, and we'll talk about why that is a little bit later. So it's important for you to kind of review the information in your credit reports, and it's more important really for you to check that all the data is accurate so that no matter what score is pulled when you're seeking credit, that the appropriate score is created for you based on your data. All right, so what do you do if you find mistakes? Mistakes can happen. There's lots of different things that contribute to mistakes on credit reports that the credit bureaus take care of. But it's really important as a result of that to check your credit reports carefully to ensure that all the information is correct. And if you do find a mistake on your credit report, you should contact the credit bureaus immediately. You want to document all your interactions and conversations in writing. If you access your credit reports online, there's even an option next to where you're seeing an error to dispute that record and provide some documentation or information. And then you also want to reach out to the company that provided the information to rectify that it is updated appropriately. However, if the information isn't wrong, for example, you didn't pay the debt and it was turned over to a collection agency, or you did make the payment late, no one can remove it from your record. So if it's a collection action and you pay the debt that you owe, you can ask the creditor to contact the credit bureau to remove the action that is on your report. It might be a negative action about the past due balance. And you can add good credit behaviors, which we're talking about today, to your report, like making payments on time, for example, to balance out some of the negative ones that might be on your credit history. So we talked about Jessie checking their own report, and part of the reason why it will stay the same is related to hard versus soft credit inquiries. These are two different types of credit inquiries that can show up on your credit reports. So for a hard inquiry, this is when a consumer is actively seeking credit from businesses. It could be seeking credit for a loan, for a credit card, for a lease, for insurance, for employment even. And this will temporarily lower your credit score. It stays on 2 years and it only makes an impact briefly, but it can make an impact. So you want to minimize how many hard inquiries you're making on your account. So similar types of hard inquiries that are made around the same time frame are pooled into a single inquiry so you can comparison shop. So for example, if you're going to buy a car and you are shopping around for rates, if you apply for multiple car loans in the same 5-day period, that will show up as one hard inquiry. It will be pooled as one hard inquiry on your credit report. Soft inquiries, on the other hand, is when a consumer is checking their own credit or a lender is checking your credit to provide a pre-approved loan offer or credit card offer to you. And soft inquiries do not influence credit scores. So that is my little tip for hard versus soft inquiries. So we have another little quiz that we're going to do, and hopefully I will pull it down before I start talking about the next thing. But we're going to talk about Stevie. So Stevie needs to buy a car and wants to get a loan to pay for it. To not hurt their credit scores and get the best rate, APR, on their loan, which of these is the best strategy? And I might have alluded to this already when I was talking. Accept the loan offered by the car dealership. For the next few months, apply for a car loan monthly to find the best interest rate. Apply and compare loans within 2 to 4 weeks and choose the best option. So what do you think? We got 45% of people that have participated so far. Most people are saying apply and compare car loans within the 2 to 4 weeks and choose the best option. Some people are saying accept the loan offered by the car dealership. Some people are saying shop around monthly to find the best interest rate. Don't forget to submit if you have that option after you've made your selection. All right, we have a lot to go over, so I'm going to go ahead and end the poll and share what we got. So the correct answer is apply and compare car loans within just 2 to 4 week period and choose the best option. Remember when I talked about hard versus soft credit inquiries, and that hard inquiries on the same credit type are pooled as one inquiry when you're so you can shop around for loans? That's what's influencing the best option for Stevie searching for a loan to get the best interest rate for her car. All right. Remember that credit reports and credit scores are different. They are commonly thought of as the same thing, but they are not. A credit report is an official document compiled by one of the 3 major credit reporting agencies, Equifax, Experian, or TransUnion, and it shows information like your name, address, social security information, types of credit you use, when you opened a loan or line of credit, balances and available credit, information about whether you pay your bills on time or not, and any accounts that might have been passed to a collections agency, as well as how much credit you've opened recently and any records related to things like bankruptcy, tax liens, court adjustments, etc. Your credit report does not show your credit score. A credit score is a raw number that's calculated with an algorithm that is used by lenders. That's also used by apartment companies, leasing agencies, potential employers, all to determine kind of your risk, the risk of doing business with you. And that applies to many different aspects of our lives, not just how much we pay for a loan or how much we pay for credit. And you can get your credit score from different websites. You might have to pay a little bit of money. Some scores are offered for free, but you might be you might have to watch ads, or there might be ads associated with where you access these scores. FICO is the most popular score, which ranges from 300 to 850, but there are a lot of other scores out there. And there's lots of free resources now to check scores. Some lenders or financial institutions even provide scores as a benefit of having a business relationship with them. So there's lots of different ways to get scores. I forgot to stop sharing the last credit quiz. Hopefully you exited out of it and you could see my beautiful slide. But I have another quiz for you to check your knowledge. So we're going to compare Stevie and Charlie. And I just launched it, but of Charlie and Stevie, who is likely to receive a lower APR for their car loan? Charlie pays cash for all their expenses, has an emergency savings fund, and works full time. Stevie also works full time, has a low revolving balance on credit cards, and makes payments on time every month. All right. Um, while people are responding, someone asked, would you say that score reports and monitoring for Credit Karma is accurate? Credit Karma is a company that makes money off of providing targeted ads based on your credit history, as well as other kind of information. It's best to go to the source, which is annualcreditreport.com, in order to get your reports. But a lot of people use Credit Karma for monitoring. The FTC has fined Credit Karma a couple times for failing to provide certain securities to people using Credit Karma to monitor their credit. So just keep that in mind if you choose to use a service like Credit Karma. Do your due diligence on whether or not that is a company that you want to have monitoring your credit for you. All right, so lots of people have responded, and it pretty much unanimously says Stevie is going to get the lower APR. And that is true because it's very likely that Charlie's credit invisible, which is unfortunate. There's a lot of people that are credit invisible because, you know, they don't have any um, credit history for people to make any risk decisions on. There's no data available. All right, so if you are denied credit because of your credit report, your credit history, you are legally entitled to a copy of your free credit report thanks to the Equal Credit Opportunity Act. You can also get your credit report for free if you've been denied insurance because of your credit history. And the business that turned you down should give you the information you need to get your free credit report. Typically, you'll have to reach out to the credit bureaus directly for these reports. But since they're offered online for free every week, you may not need to go this route if you are denied credit. But it is something that we wanted to mention since you're legally entitled to it. And we haven't always had such great access to our own credit histories. All right, so I believe it's Nikki's turn to take over using credit wisely or regularly or both.
Hi. Yes. I know, Andrew, can you check the chat? There's a question in there that from Anna Marie that I was starting to answer, but I'm gonna switch back over.
Okay.
All right, so using credit regularly, another way to build your credit is to use it. All right, we are going to, this says it's a case study poll, but we're actually, it's just popped up there. Go ahead and read that. Sally is 75 years old. She has paid off her car and house loans, prefers to write checks over using credit cards, and her credit scores has gone down as she is not using credit regularly. Why should Sally care about her credit scores? So go ahead and answer. All right. I see people coming in. Lots of choices here. All right, got about 70. This is a very interesting, almost all evenly split here. So Andrew, you wanna
I am
go ahead?
sharing the results. Did you want to discuss any of the results?
So Andrea, I actually can't see it. So can you go ahead?
Yes, yes. So, a lot of you said equally Sally's car insurance premiums could go up because her credit scores have gone down, which is true. Sally's health insurance premium could go up because her credit scores have gone down, also true. To maintain a credit score, as we know, you need to use credit regularly, so that is true. When shopping around for better rates on homeowners insurance, Sally's lower credit score may limit her options for saving money, which is also true. And Sally may be willing to co-sign on a loan for grandchildren or children, but a lower credit score for Sally could impact their ability to get a loan or the rate that's offered. So one thing to note is that if you are asking someone to be a co-signer for you, they might have more credit, but if it's bad credit, you're going to have a lower rate or a higher rate, worse cost. All right, so I'll stop sharing and then we can go back to the Nikki show.
All right, so case of the credit invisible, a lot of people feel like, well, I'm just not going to use credit and then my score will be, everything will be fine. And that's actually not true. It's understandable why people sometimes choose to actively avoid the use of credit, but the truth is that we live within a society that makes it incredibly difficult, sometimes impossible, for people to get opportunities to improve their financial well-being if they do not have a credit history or have poor credit scores. So 19% of American adults do not have a conventional credit score. So that's 28 million adult Americans who are considered credit invisible, and then 21 million who are unscorable. An additional 57 million people have subprime or below credit scores, which means all of these people are going to have a hard time accessing financial services. Credit invisibility more frequently impacts underserved communities. 26% of Hispanic consumers and 28% of Black consumers are unscorable or invisible, compared to 16% of white and Asian community consumers. Also to note, particularly with the demographics that we saw earlier about who's on this particular webinar, credit invisibility often impacts younger consumers. So 40% of credit invisibles in the United States are under 25. And that's usually because they may not have a credit card or they don't have a lot of purchases and they think, hey, that's fine. However, what that means is you're also not building credit. So remember, we talked about the credit report and they look at your history and how much risk they can take on you. When there's no history there, a loan servicer has no idea what risk they're taking. So then it is harder for them to loan to you. All right, so what is a secured credit card? Most credit cards are not secured. So I'm just gonna first say that so you don't get confused that Not every credit card is a secured credit card. It is a type of credit card. It basically is used specifically to help you rebuild or reestablish your credit history. It requires that you actually deposit money at the same time in an account as you open your credit history, as you open the credit card. So if you deposit, as the example says, $500, then your credit limit is only going to be $500. It's not like credit cards where you open it up for free and they give you a $10,000 credit limit. This is specifically designed to help you build your credit. A lot of times, not always, but sometimes this money will earn interest, not as much as necessarily other credit cards. And typically a secured credit card does have an annual fee and a higher interest rate than an unsecured credit card. If this is a route that you think may be good for you to take to start rebuilding credit or establishing credit, just know that just like regular credit cards, all secured credit cards are not the same, and you need to make sure that you're asking questions and you read the credit card agreement to understand. Some of these questions include: what interest rate will be charged on balances? What fees may be charged and how much are those fees? What is the grace period or the number of days you have to pay your bill before the interest charges start? And make sure the credit card agreement does not require any other expenditure, any other fee from you, such as setup fees, or sometimes they may say you could have the credit card, but you also have to purchase an insurance policy. So you also want to make sure that that company that's issuing the secured credit card will report your payment history to the credit bureaus. So this way you can start to begin to build your credit history by making those payments on time. As always, with any credit card that we talk about or anything really related to money, make sure that you are comparing and shopping around and trying to find the best card that fits your needs. A secured personal loan is also referred to as a credit builder loan. It functions a little bit the same way as a credit card. You secure a loan with your savings and it helps you build your credit history, much like the secure credit card. These are both tools that you can use to help you build your credit score back up. One thing that we want to highlight is, besides these webinars, we also have a podcast. There's a few. This one is the Family Financial Feuds, and it's a podcast specifically about authorized users on credit cards. So that may be something that you want to check out, especially so that way you understand what an authorized user does and who is responsible for what. Federal student loans. We are not going to talk a ton about federal student loans here. Andrea and I do an entire webinar just on federal student loans in the spring, but this is just a few things that we wanted to highlight differently. Your federal student loan does not always require a credit history. If your federal loan is subsidized, then there are no interest charges until you graduate, you drop below half-time status, or you leave your school. You only borrow what you need or a small amount, and paying back regularly after leaving school will build credit history. Also, something to note is that if you put it on automatic payments, that may reduce the interest rate costs as well. Just keep that in mind, and remember what we said at the beginning, that defaulting on a student loan means that it never comes off your credit report. Buy now, pay later. This is something that is becoming increasingly popular. It's basically plans that divide your total purchase into equal payments. And then when you go to buy that payment, you only pay the first payment when you check out. So for example, my real life example would be that we bought a couch. We were able to do a buy now, pay later plan that took the total larger purchase of our sectional couch and divided it up into equal payments. And we only had to pay the first payment at checkout before interest. However, it is a mixed bag. There are definitely pros and there are cons. You have to be careful that you're using this to the best, to what is going to benefit you. A Consumer Federal Protection Bureau report from March of 2023 found that a majority of buy now, pay later borrowers face credit card interest rates between 19 and 23% annually if they had chosen to make their purchase just using a credit card rather than the buy now, pay later plan. So just know that there are some good things and there are some bad things. And so you have to weigh that. So pros, it's very convenient. You may be able to qualify for a buy now, pay later plan. Even if you do not have good credit, it may be interest free. The case of my couch was that. It's very commonly available and it doesn't require a credit card. But the cons would be that it does add debt payments to your future. It's easier to overspend, and the credit impacts are vague. Sometimes it's good, sometimes it's not good. So if you're somebody who's trying to rebuild your credit, that may not be a way for you to go. Interest is very high. And then you're also risking late payment fees. Sometimes just a fee to use that feature. And it may be difficult to stop the payments if you return the item. So they are very popular right now. Just make sure that you are checking into everything. Your credit, your choice. You can choose not to use credit. I apologize. We're just making sure that you understand the challenges of just not using credit. You may choose to only use credit sparingly. This is your choice, but no matter what your choice is, we highly recommend that you check your credit reports regularly. All right, a little quiz here.
I'm going to try to launch this and take over from my coughing colleague. All right, so we're launched a credit quiz. What is the most important factor in a FICO score calculation? Is it the amount of debt, amount in retirement savings account, a number of years of credit use, or payment history? What is the most important factor? So you have all these different elements or characteristics of your credit history, all these things that are in your credit report. And what do you think that the company FICO it thinks is the most important? All right, so most people, we have 60% people have participated. Most people are saying payment history. Some people are saying amount of debt, and other people are saying number of years of credit use. Nobody likes amount in retirement savings account. All right, I need to wrap things up super quick and we have a lot of slides. So I'm going to share the results. The answer is payment history, and I'm going to talk about why. So that third habit we talked about was make payments on time. And the reason that you want to do that is because it makes up a significant part of your credit score. FICO scores are the most popular scores used by lenders. They have something like 50 different algorithms that they've sold over time. They might have more now. And they try to keep it mostly a secret. But in general, experts are saying that 35% of the credit score is payment history when it comes to FICO. There are other things involved as well. The other type of score that's very popular, especially if you get your score through Credit Karma or your financial institution, is Vantage scores. So the thing that I want to highlight here is that for both FICO and Vantage, they're going to be looking at payment history and on-time payment history as the most important part of those scores. So no matter what your score is today, the most important thing to pay attention to improve that score or maintain it at a high level is on-time payment history. Lenders care about other things than scores, though. So, in addition to looking at your credit worthiness through something like a score or reviewing your credit history in your report, they're also going to look at what assets you have. They also might look at your capacity to repay them. So, what existing debts do you already have out there? And they're also going to look at your employment, like what kind of income do you have coming in, so that they can make a informed decision on whether or not they want to do business with you. Nikki and I actually dedicated a whole podcast episode of Making Sense of Money to credit scores because they are super complicated. It's a little bit older, but a lot of the information is going to be the same. Nikki, do you want me to continue talking since that was just a brief part and you've been coughing?
Only if you're okay with that.
Yeah, I'm totally okay with that. So let's talk about paying down debt. This is the fourth habit that we wanted to highlight. So, you can pay off your credit cards completely every single month. Some people have this myth that you have to maintain a balance to establish credit history. That's not true. I pay my credit cards off every single month, and we use it for like daily transactions, my partner and I. And keeping a revolving balance on your credit history does not really help or hurt your credit history, but it does cost you money if you maintain a balance. The second most important factor in FICO scores is the amount of debt owed. So we will talk about why that is. So lenders look at your debt to income ratios. That was another thing that we talked about. Lenders use different debt to income ratios to determine if you can take on more debt payments. And you actually need to decide what you can comfortably afford on your own. When they're making these debt to income ratio calculations, they're not looking at your lifestyle choices. They're not looking at how you like to spend your free time. They're not looking at how many vacations or how much travel you want to go on. They're not looking even at what your medical costs are or anything like that. They're going to make it solely based on what a risk calculation is, considering your credit scores, your assets, your debt to income ratios, etc. So keep that in mind. The other thing that I wanted to point out with this particular slide is there's a little bit of variance with income volatility, even though the debt that you have to repay stays the same. There might be some income volatility if you work contract jobs or hourly or you have seasonal jobs, and you need to keep that in mind because it's your responsibility to repay the debt that you have agreed to do with that contract. All right, so another thing I want to explain real quick is credit utilization ratio. This is your this amount is your revolving credit that you currently are using divided by the total amount of revolving credit that you have available. For example, you have a credit card, it has a $5,000 limit. You are currently using $2,000 of that when your credit is pulled. So the credit utilization ratio would be 2,000 divided by 5,000, and that equals your credit utilization ratio. Because I pay my credit card off every month, if I'm going to go seek out credit, like if I want to go get a car loan, I make sure that my credit card is paid off when my credit is being pulled. So it's the lowest credit utilization ratio that they're going to pull, because it could, FICO score is going to be way different if they pull it when it's higher, right? And there are different kind of rules of thumb that people abide by with this credit utilization ratio. Some people say 30%, some people say keep it less than 25%. The algorithms are kept kind of a secret, so it's up to you on what you're most comfortable with, but the lower is better when you're looking at its impact on scores. All right, so another thing you want to do is avoid drastic credit changes because of the complications related to how it impacts our credit worthiness. You don't want to make any changes in your available credit right before applying for something big. So you don't want to add new credit cards to the mix. You don't want to make a bunch of big purchases on credit. And you don't want to close lines of credit because it impacts that credit utilization ratio. So if you already have 4 or 5 credit cards, you don't want to close one right before seeking out a mortgage, right? However, if you are concerned that your credit, available credit is too high for a potential lender for a mortgage to give you additional uh, debt to take on, you might want to have a longer term plan on how to manage that overextension of credit that you may feel you're experiencing. All right, so to summarize, how to build your credit. First, check your credit reports regularly, whether or not you want to use credit, because it is a choice. You do want to use credit regularly if your intention is to build credit. You want to make your payments on time and you want to pay down existing debt. Those things will help you to build positive credit habits and positive credit history. So your next steps, you want to pull your credit reports. You want to make your own plan based on what your credit goals are, and you can identify additional resources. We're putting a bunch in the chat. We're also going to share this recording once we have it captioned appropriately and edited appropriately and put on YouTube with anyone that registered for today's webinar. We also have a post-webinar survey that you can fill out. So thank you to Richard for sharing all the resources and also sharing the post-webinar survey. We will include this when we send out the recording as well in our follow-up email. It'll probably be a couple weeks. Hopefully we'll get it to you before Christmas, but it's a little bit time consuming to get the captions edited appropriately. If you missed it when I first started today's webinar, we also are going to be doing taxes webinars in January. So we're partnering with University of Illinois Urbana-Champaign's College of Geese. And we're going to be talking about tackling taxes on January 16th. And we're also going to do a taxes for international students on January 23rd. And you can register for both of those webinars at the link that we are going to have Richard put in the chat. And then you can watch previous webinars on YouTube. And these are all of our collaborators. We'll stick on for a few minutes. I know that we have a whole bunch of questions. If you sent me a direct message, I am not looking at the meeting chats when I'm presenting. So if you can share that with the whole group or put it in the question and answers function, that is helpful if you need anything specific or you want to stay anonymous. All right. I know that my good friend Steve Bob was answering a lot of questions. Steve, was there anything that we missed in the webinar content that you want to make sure to highlight based on some of the questions you were getting?
I'll just throw out there that this is a very complicated topic. I've been studying it and involved in working on things related to this for many, many years, and I still don't understand it all. Just keep doing research. You will find conflicting advice out there. You'll have to decide what you think is best for you. But you can use it to your advantage. But you do have to take it seriously. So hopefully that's helpful. I'll answer other questions if people have specific questions.
Thank you so much, Steve. we did get some Q&A questions. We have, is it better to pay off a chronically delinquent account in full or accept a settlement offer? I don't think I can answer that question. I think that is a financial professional question to ask because there's other factors that go into that. You have to consider what your money personality is, right? What your comfort level is, and what the potential impacts on your long-term goals are when it comes to accepting a settlement offer versus paying off a chronically delinquent account. We all have different biases related to debt and debt management, and that's important to acknowledge. But because it could be specific to an individual person, I think you need to seek a financial professional for that one. And then,
This is Steve. I'll just
Go ahead.
throw out there.
Go ahead.
I tend to be very cautious about settlement agreements. I got a lot of training from a former banker, and he told me once somebody doesn't pay a bill or makes a settlement offer, that makes me really nervous that they'll try to get a settlement with me the next time. So I'm less likely to want to lend them money. So I just tend to be really cautious about settlement offers. And the other thing sort of related to that, and this really confuses things, but once debts get really old, then there are some other issues. So if something's been outstanding for 6.5 years, if you make payments on it, you might activate that for another 7 years of visibility on your credit report. So that's another thing to be cautious about if it's really old.
Thank you, Steve. I think that's really insightful and kind of points to the complicated nature of credit, how it's so individual, things like long-term delinquent accounts, as well as like whether or not to close a credit card because of outstanding kind of credit availability and its risk from a lender's point of view varies so significantly, so much. We had another Q&A question. Does your credit score decrease after we file a dispute? I filed 2 disputes and my credit score fell by 22 points after filing the dispute. Steve, do you feel comfortable addressing this one?
I'll say a few things. I don't believe it should change after a dispute. Now, I don't like to say this, but I will. I know that people sometimes there are some people out there who I think are very corrupt who say that you file a dispute on everything, hoping that some creditors won't respond and you'll get stuff off. And the other thing is, my understanding is that when you file a dispute, if there's no response in the short term, your credit score will actually pop up while the dispute is in the process. But then if the creditor says, wait, you shouldn't have, this dispute is invalid, then your credit score will drop down. To me, that's unethical, and you shouldn't be playing those games. But I don't think the dispute will have a major impact on it. I'm sorry, and there was a second part to that, and now it slipped my mind.
They provided the example that they filed 2 disputes and the credit score fell by 22 points. And
Okay.
when I think about the credit point range, 22 points seems like a big drop, but we also get credit scores from different places. And if you don't pull the exact same score and nothing else has changed in your kind of credit profile, then there shouldn't be a significant drop.
No.
However, if you're pulling a Vantage score and then you're pulling a FICO score, or you're pulling a FICO score for insurance versus a FICO score for an auto loan, those are different.
So can I explain that a little differently?
Yes, go ahead.
We colloquially talk about FICO scores. The reality is FICO has, I've been told, up to 50 models, and every lender chooses the model that they feel is most appropriate for them. So there are big models. So I believe FICO now is talking about FICO 9 or 10. Those are the most recent models. And since we're getting into a little nitty gritty, I believe that the most recent FICO model does not take into into account any medical collections agency. That's something that the current administration has been pushing for. But um, the creditor that you're looking to borrow money from might be using a FICO 5, might be using a FICO 6. I used to work with somebody who worked with a very large credit bureau, credit card issuer, and they were using like FICO 3 when everybody else in the world was on FICO 5. And the reason they wouldn't change was because they had invested so much money and so much into their process that they didn't want to change. And when FICO would harass them and say, we don't want to give you FICO 3 anymore, they would say, we're willing to pay you anything because we think it's more difficult for us to change our internal processes to look at FICO 5 than it is for us to stay on FICO 3. So part of the reason that people complain, well, I looked at my credit score and it was this number and they told me it was a different number, is because they are using different models. And you can't control that. The other thing is, and I made a comment in the chat, you don't know which bureau they're pulling their information from.
Yeah.
So you want to make sure that you check all 3 bureaus, because if there's a mistake in one, and that's the one that the credit card issuer lender chooses, then that mistake's going to come through if they pick another one. After the fact, you can probably find out what bureau they use, but most people don't. Most lenders wouldn't be able to tell you that or wouldn't want to tell you that. The other thing is, when I was a lender, and I think this is probably still true, lenders look at scores in bands and they modify those bands. So if you've looked on like Credit Karma or Credit Sesame, and I get what Andrea has said about the risk of using those sites, I still think that they're a good basic thing.
Definitely a good tool. There
Yeah.
are just risks we have to be.
Yes, and that's fair. But so if they tell you your credit is excellent or good or poor, they're using roughly 40-point bands. And so traditionally, somewhere, again, it's a struggle to be sure on this, but traditionally 680 or 720 is kind of the cutoff between good and bad. But I was I'll be honest, I was at Boeing Credit Union talking to their lending department, and they said, oh yeah, we just changed our bands and we moved everything up 5 points because we felt that the risk in the market and the conditions of the market were changing, and that was appropriate. So big lenders, they know and they have their bands, but they're changing them. And from a lending perspective, if you're a 725 or a 715, to me, it's the same. But if your lending agency says your cutoff is 720, then you're either 5 points above or 5 points below. It is going to change. It's an imperfect situation. Ultimately, I tell most people, make sure your history is as accurate as possible, and do pay down as much debt as you can and keep your ratios as good as possible. And then you'll just have to go with it the way it falls.
Thank you, Steve. There were some I don't know if you can open the Q&A if you wanted to address those. And I know that Nikki is answering questions in the chat. If anyone has to drop off, we'll continue to answer the questions that we can for a couple more minutes. If you have questions you think of later, go ahead and email studentmoney@uillinois.edu. I know there's tons and tons of questions on credit. We'll try to get you answers or get you information to help you get your own answers. And we will make sure to send this recording out again once it is appropriately captioned. And sometimes our answer is going to be, I'm unsure, but here's how to find a financial professional that may be able to help you. And sometimes, depending on the legality of your credit inquiry, you may even reach out to Student Legal Services. If you're a student at Urbana or Chicago, there are Student Legal Services offices that can also help you if you're trying to resolve a issue with a creditor or something that might involve a legal perspective.
There's one question here that I think is worth mentioning, is related to freezing credit data. So let's just be honest. I believe that everybody's credit history in the United States currently has been corrupted. there are a couple great breaches in the last 6 months, and I just think that we all have to assume our data's been there. I chose to go with the lesser aggressive option where you put a note in your credit report, and theoretically anybody who's going to lend you money has to double check that you really want to borrow money. I chose that for me and my family because as a business person, I've worked with some other people who have gone ahead, and I think it's the more aggressive, and I can never remember which is which, but the more aggressive, basically your credit history goes silent. And so when someone runs a report, they don't see anything. That's nice if you intend not to borrow money. But if you intend to borrow money, then you have to open it up, leave it open. If you don't know what agency they're using, you have to open it up at all three agencies. So it just felt like more of an inconvenience in my mind. So you need to decide what you think is appropriate, but I do think you should consider doing something. And I'll be honest, I try to check my family's credit reports once a quarter, and I use Credit Sesame, Credit Karma. I also use one called Wallet Hub. And I can't remember, I think there's another one that I use. And so I'm aware of stuff that goes on and I pay attention. I think those services are worth it, but yes, you are giving up your information and you have to decide if you're willing to take that risk.
So, Steve, you were talking about credit freezes versus credit locks. Credit freezes are the less aggressive. Credit locks either require a paid service or you have to have been a victim of identity theft and have like a police report. And there's some additional things that would be needed for a credit lock. But credit freezes are free and they can be really helpful with all the data breaches that happen on a regular basis. So I agree with Steve on that. And the Consumer Financial Protection Bureau also has a lot of information on building credit, the difference between credit freeze and credit lock, the difference between credit scores, credit reports, even down to like what should I look for in an auto loan or a credit card or a mortgage. So you can definitely use the Consumer Financial Protection Bureau, the Federal Trade Commission, the Student Money Management Center website. Gotta do a self-promotion there with our website. Someone did ask if you should check out minor kids' credit scores. I think that it's important to check their reports. I don't know about scores, but
Um,
go
I had,
ahead, Steve.
yeah, I believe I locked my kids' reports. I can't find the records to be honest. So, but I did do that a couple years ago just to protect them and figured that I would rather hope that they didn't have anything. Honestly, I was a victim when I graduated from college many years ago. I went to get a utility and was told, no, we can't give you a utility. Your credit score has been used by someone. And I had to get a letter from I think from the school registrar saying that I lived in the dorm during the period when my credits had been used to get the utility company to give me the services that I wanted at that time.
And it's if you have a minor child that has some type of fraudulent credit activity on their account, it's much easier for them for it to be resolved before they turn 18. So if they're 17 or younger, it's easier to get it resolved. We've seen instances of students who are 18, 19, 20 whose a family member used their social security number to open utilities and never paid the bill. And then it's on the student's credit report and they have to file charges against that family member if they want to resolve it from their credit report. So in most cases, the students just live with the consequences of the family member that used their identity without their knowledge. Well, we could answer questions all day long. Just a reminder for the last question we got in, you are not entitled to receive your score for free annually. That's something specifically not legally entitled for you. It's only reports. So keep that in mind. Because we're 15 minutes over and I don't want to make this a 2-hour recording. If you do have questions that didn't get answered, feel free to email studentmoney@uillinois.edu and we will get you an answer and we will send this recording to everyone. We'll even review the meeting chat to maybe come up with some FAQs to answer for our website. So thank you again for joining us and for being so open to participation and answering our polls and asking questions in the chat. Big thanks to Steve who hopped on at the last minute just to kind of help us out. Your knowledge is really helpful. And Nikki and Richard as well. Thank you for helping. And
Sorry,
go ahead. Go ahead, Nikki.
it's studentmoney@uillinois.edu, right?
Correct.
So I put it in the chat. I know that there were some very specific questions about where also like U of I staff could go to for help and things like that. So if you guys want to email that email address, I unfortunately, because I don't work at U of I, I'm not privy, or I don't know those things off the top of my head. So just make sure you email those questions in and I could direct you.
Yes. So thanks again for joining us. Nikki, any last words of wisdom on credit?
I'm sorry I had a coughing fit, but thank you guys all for hopping on. And we hope to see you guys in future webinars as well.
Agreed. Sign up for taxes. We're also going to cover investing, student loans, and the psychology of money next semester.